Okay, so very good evening and welcome to the next subject that we are going to start. This is pertaining to derivatives, and this is a topic which is in a way common to your CA final AFM if you have done that. Uh, to be honest, your derivatives over here is of a slightly lower level as compared to your CFA, compared to your CA. You have more topics, but the variety of questions in CA are a lot more. It is at level 1, then at level 2, it goes a little more advanced. So when we look at this subject, I would say there are a good 10 readings in this subject. And for students who have just done their intermediate, this is a relatively newer subject. If you have done your final CA, this should be a much more easily manageable subject. Having said that, I would say this is a subject, I believe, which has the lowest weightage. So when I go to see, it has close to 5 to 8% weightage. So when I look at this, that is anywhere between, I believe, I think 9 to 14 odd questions, if I'm not wrong. So this is around 9 to 14 MCQs that will come from the derivative section. I believe this is in your second session in your main exams, but in terms of weightage, it has certainly it has the lowest weightage. Even economics or corporate issuers has around 6 to 9% weightage. Derivatives, surprisingly, to my surprise, I think this is an important area. It definitely demands more weightage, but the CFA Institute gives a maximum of around 5 to 8% weightage for this subject. Nevertheless, every mark and every question is important for us. So whether the weightage is 11 to 14% or it is 5 to 8%, we will do it with the same level of detail. So when we look at derivatives, there are 10 odd readings, and in the beginning, I think the first 4 or 5 readings pertain to a bit of theory and a bit of understanding around derivatives. And then when you see the other chapters, like this is all pricing and valuation, one for forwards, one for futures, one for options and swaps, and there would be the first 4 regarding the basics of derivative, the next 4 regarding the pricing and valuation of these derivatives, and then there are a couple of specific areas like the put call parity and the binomial model, which are studied in the last 2. The detailed binomial Black-Scholes, etc. is ideally done in your CFA level 2. So this is regarding your derivatives. Now when you start with the first reading, this is reading 66, derivative instruments and derivative market features. Over here we are going to largely study regarding the features of a derivative, trying to understand what is meant by a derivative. Now as the name goes, derivative derives value. Like an equity share has its own value from the cash flows it generates, from the free cash flow, the dividend, etc. that is there. On the other hand, when you look at, for example, even a bond has its own value from the interest, from the principal on redemption, as the case may be. So these are instruments which have their own intrinsic value. On the other hand, you have a derivative which derives value. What does it mean? Like, for example, when I look at a forward contract, an example of a derivative is a forward contract. Like, for example, you might be an importer, and as an importer, you might have to pay, let us say, a supplier $1,000. Now, today's date, for example, is 1st of January 2025. Now, let us say you need to make the payment of $1,000, which is due on 30th of June 2025. That is after 6 months. Now, you are a very risk-averse kind of a person, which means, yes, you have purchased the goods on credit. You need to make the payment after 6 months. However, let us say the spot rates on 1st of January 25 is rupees 80 per dollar. Now, you are very worried about the exchange rate. You think that the rate is been very volatile. It can go from 80 to 85, 86, in which case your import bill will shoot up significantly. So you are a risk-averse investor and you are getting, let us say, sleepless nights, in which case, what should we ideally do? Well, in such a case, what we will try to do is, we will try to take hedging. Hedging means trying to reduce risk, and for taking hedging, you can enter into a contract like a derivative contract. So when I enter into, let us say, a forward contract, what do you mean by a forward contract? A forward contract refers to an agreement that is entered today, that is on 1st of January 25, for buying the dollars. Achha, am I going to buy the dollars today? No. You're going to buy this after, let us say, 6 months. So this is an agreement that you're entering today to buy a specified amount of the foreign currency on a specified date, that is after 6 months, at a specified rate. Let us say the forward rate that is agreed between the bank and the entity for 6 months later is around 82. Maybe it is greater than the spot rate, but you are worried that it will go up to 85, 86, and hence you are okay taking this rate. So over here, let us say the 6 month forward, the 6 month forward is rupees 82 per dollar. In which case, over here, when I look at 82, it means after 6 months, that is on 30th June, if I were to buy the dollars, I don't have to see the actual rate prevailing. Now, the rate could have become 85, 86, 88, we don't care. Or it can even become 75, 74, it does not matter. You will have to buy and pay at the rate of 82 per dollar. Now, you might say that there can be a gain, there can also be a loss. Yes, it is like an insurance contract. Now, insurance when you go to buy is essentially for risk reduction. Now, if you take a medical insurance and you don't fall sick in the entire year, you're not going to cry, why did I not fall sick? My premium went wasted. No, you wanted peace of mind that even if you fall sick, you will still have an insurance cover which you can kind of claim. So over here, when you're looking at a forward contract, there is a 6 month forward, which is let us say at the rate of rupees 82 per dollar, which means after 6 months, when I have to pay the supplier, I will go to the bank with this piece of paper that is a forward contract, and I will pay 82 for every dollar. That is for $1,000. I'll pay 82,000 rupees and in return get $1,000. So over here, after 6 months, what we will do is we will go to a bank, and to the bank we will give rupees 82,000. Let us say the spot rate on 30th June 25 is, let us say, rupees 85 per dollar. I will still buy it at the rate of rupees 82 per dollar only. So I will pay $82,000 to the bank, and in return I will get $1,000. And this $1,000 I will hand off to my supplier. So my cost is kind of fixed. So this is a use of a derivative for the purpose of hedging. But what is a derivative? We said that this is, let us say, a currency forward is a derivative contract. Now, what are the features of a derivative? The feature of a derivative is, let us say, derivative is a piece of paper like equity share, like a debenture, etc. In a similar way, a derivative like a forward contract which is entered for delivery on 30th June 25 for $1,000 and at an agreed rate of rupees 82 per dollar. This will be signed by the entity, will be signed by the banker. Now, this forward contract at initial recognition, that is on 1st of January 25, usually has a nil value because the banker and the entity are entering into a contract which is kind of a fair contract. None of the parties are getting an unfair advantage at this point, because 6 months later, I genuinely believe that the rate will be, let us say, 82. The banker believes that the rate is 82 and hence initially the value is nil. However, will the value change? Well, yes, as the rates change, let us say, on 1st of February 25, 1st of March 25, and so on. Let us say your expected rates instead of 82 now is 83. We are expecting that by 30th June for contract to be delivered on 30th June. If someone comes to me on 1st of February and says, I want a 5-month forward on 1st February, I believe that on 30th June, the rate would be around 83. Why? Well, because the spot rate changes. Today, the spot rate was 80. I expected the rate to be 82 after 6 months. Now, suddenly in the month of January, the spot rate changes from 80, let us say, to 82. Now, in our wildest of dreams, I will not say that this rate will remain the same for the next 5 months, and hence I'll say the rate after 5 months can possibly be 83. Usually, as the spot rate changes, the forward rate also changes. Later, it might even become, let us say, rupees 84 and so on. Now, the point over here is, this piece of paper earlier had a zero value. However, if someone wants to enter into a similar paper on 1st of February, they will have to agree to buy at the rate of rupees 83. However, we have a paper here which is agreeing to give us those same dollars on 30th June itself at the rate of rupees 82. So our paper will entitle us to buy the dollars at a slightly cheaper rate, that is 1 rupee lower. And hence, if I want to find the fair value over here, the fair value can simplistically be 83 per dollar minus rupees 82, which is agreed per dollar, into, let us say, $1,000. And hence, the fair value over here is going to be 1,000. So this is going to be, let us say, your fair value, which is going to be 1,000. Now, as I say, this derivative or this forward contract is deriving value. It is deriving value as the dollar rate changes. As the exchange rate changes, the value of this piece of paper will also undergo a change. I will again repeat, as the exchange rate changes, the value of this piece of paper will also undergo a change. And as a result, over here, this is a contract which is deriving value from an underlying. The underlying over here can be various things. It can be dollars, like in this case. It can also be shares of a company, like you want to buy the shares of Reliance after 6 months, but you want to enter into a contract today. You don't want to buy it today. You want to buy it after 6 months for whatever tax reasons or whatever, in which case, or let us say you want to sell after 6 months. Like maybe it will become a long-term capital asset and hence you want to pay a lower tax. So you want to sell after 6 months. You don't want to sell today, but you are worried about the fluctuations that might happen in 6 months. And hence you might enter into a forward sale on the shares of Reliance, in which case your underlying is the share of Reliance. Now, you might enter into a contract to sell the shares of Reliance at, let's say, 2,000 rupees. Now, after 6 months, the rate becomes 2,500 or the rate becomes 1,500. We say it does not really matter. For us, the deal will happen at 2,000 only, which means the value of that paper will be dependent on how the rates are changing. So today, both I and you believe that the rate after 6 months will be 2,000. However, 1 month, 2 months, 3 months later, our expectations might change. So we now believe that the rate after 6 months may possibly be 1,800. However, you are holding this piece of paper which entitles you to sell these shares at 2,000, which means this piece of paper carries a 200 rupee value. It allows you to sell something at 2,000, which in the market would have been sold for 1,800, and hence 200 rupees is the value. What I'm trying to come to, again, we are going to do the pricing and valuation later, but what I'm trying to come to over here is, when you're looking at a derivative derives value. It does not have its own value, it derives value. Like a share, value is based on its intrinsic cash flows. A bond, value is based on its interest and redemption value, intrinsic cash flows. However, when you look at a derivative over here will derive value from an underlying. So when I look at the derivative, a derivative is basically an instrument which first derives value from an underlying. The underlying asset over here can be a share, it can be a bond, it can be a currency item, it can be a commodity, it can be any item. So essentially, a derivative will derive value, let us say, from an underlying. That is the first.